We've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if we went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is they've turned bullish. And from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why if someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it.
Gold, silver, and platinum prices have experienced a sudden and violent pullback, one that has caught many traders off guard. Gold fell nearly 5%, silver dropped around 7%, and platinum group metals slid by almost the same magnitude. For casual observers, it might appear that the precious metals bull run has stalled, or even reversed. But beneath the surface, this sharp correction looks far less like a market-losing conviction and far more like one being deliberately shaken. Alasdair Macleod, in his latest interview, offers a view that cuts through the noise. What we've just witnessed may not be a sign of weakness at all, but the result of strategic positioning by the same powerful institutions that have long dominated the metals market. Historically, bullion banks and large derivative players have shown a near-instinctive ability to act in unison when gold and silver start rising too fast. When sentiment turns bullish, as it recently did, with even establishment names like JPMorgan's Jamie Dimon acknowledging the possibility of gold hitting between $5,000 and $10,000, and Morgan Stanley advising clients to allocate 20% of their portfolios to gold, the banks that trade on the other side of those positions often move quickly to restore balance. The resulting volatility tends to flush out speculative longs, narrow their own exposures, and reset the price floor. But if this really is such a coordinated shakeout, it may also be a sign that the upward momentum in precious metals has grown too strong to ignore. Data from the futures markets support this interpretation. Open interest in COMEX gold remains less than half its long-term average, suggesting that this rally has not been driven by excessive speculation, but by structural demand. Central banks, particularly those outside the West, continue to accumulate at a record pace. Retail investors, burned by years of paper gold manipulation, have turned to physical holdings. And large hedge funds, many of which missed the early stages of this rally, are now beginning to shift their positioning toward long exposure. The market, in other words, is consolidating strength, not losing it. These dynamics point toward a potentially explosive setup for the months ahead. Every attempt to suppress gold and silver prices in the past decade has ultimately given way to stronger rallies once the forced selling subsides. With inflation remaining stubborn, sovereign debt ballooning, and global trade realigning toward commodities and hard assets, precious metals continue to offer the kind of asymmetric protection that few other assets can match. The real story may not be the temporary fall in prices, but what, and who, comes next when the consolidation ends. In this discussion, Alasdair Macleod dives deeper into these forces, not just the mechanics of the current correction, but the larger geopolitical shifts shaping it. He explores how China's quiet construction of a gold-linked trade network could signal the emergence of a new Bretton Woods moment, one where gold once again anchors global commerce. He also outlines how central banks in the global south are positioning themselves for a post-dollar monetary order. If you find this analysis valuable, make sure to like this video and subscribe. It helps more investors discover in-depth discussions like this one. Thanks, and let's dive right in.
I think basically, when you look at how much gold and silver and indeed platinum group metals have soared in recent months, some sort of correction was definitely on the cards. But the interesting thing is that the whole thing has really been a short squeeze. If you look on COMEX in particular, the speculators are just not there. I mean, they haven't really bought into it. The way I would measure that interest is looking at open interest. An open interest in gold is less than half the long-term average. Open interest in silver is roughly at the long-term average. I mean, there are obviously a few speculators in there, hedge funds, whatever. Not all that many. So this shakeout, it looks sort of suspiciously coordinated. I don't mean that, over the weekend, various bullion banks got together and had a meeting and decided to bash the market. But you do get this feeling, when you're a jobber. I mean, I've known jobbers, which is really what they do. I mean, the market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970. And they do have this sense, if you like, in the market when it's right to bash the price of something which they're short of. It's almost like a second sense. And if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So, you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here. We're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands and watch this play out a bit before they decide, shall we buy some? And if so, what's a level? And so on and so forth. So, this is why I think this shakeout has been so severe. I mean, I'm looking at what's happened in silver. I mean, silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. I mean, these, given the rise that we've seen, this isn't actually all that great. I mean, you would just say, this is volatility. I've always told people, don't trade this market. I mean, you'd be nuts to trade it because the guys on the other end are so powerful. They'll take every cent you've got off you if you're going to trade it. And, the answer basically is that you've got to work out why you're interested in gold and silver. You've got to understand what gold and silver, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement, there is no counterparty risk. And the volatility isn't so much in gold. Obviously there's a bit of volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for because they've got quite enough gold. Not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it, you tuck it away. Otherwise, don't mess with it. Forget it. It's a waste. You'll just have sleepless nights if you try and trade it, because I can tell you, you try and trade this market, they will take you for every cent you've got. That's the reality of it. I think there's another point which is worth making. We've seen various large American banks, turning bullish on gold. Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement from an establishment bank like that. I could imagine that Scott Bessent would sort of phone him up and say, "Why are you messing up my world?" You know? But so they've turned bullish, and from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why. If someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it. I really could, because what they would want, it's not that they're anti-gold or silver, it's just they want to get their position square. And I think this is a desperate attempt to just do that. Let's try and, get our bears closed a bit, and then at least, we can trade it at a higher level. I think that's what's going on, if you like, in London and New York.
The heart of Alasdair Macleod's analysis begins with perspective. He reminds us that sharp corrections are not only normal, but often essential in markets that have run ahead of themselves. Gold's 5% and silver's 7% declines, while headline grabbing, pale in comparison to the gains these metals have posted over recent months. The scale of the move, combined with thin speculative participation, suggests that the current dip is not a breakdown, but a rebalancing. What makes this episode notable is the precision of the selling. It bears the hallmark of seasoned market makers who understand timing and sentiment, as well as anyone in the business. In this environment, retail traders are often the casualties, while long-term holders tend to emerge stronger. Macleod's advice has been consistent. Don't trade gold and silver. Understand why you own them. They are not speculative vehicles, but monetary anchors. Legal money without counterparty risk. The volatility, he points out, lies not in gold itself, but in the currencies used to price it. When China sells dollars to accumulate gold, it isn't chasing returns, it's defending purchasing power. And as the world's monetary system grows more fragile, that quiet strategy of accumulation is beginning to look increasingly prescient.
The central bank community, particularly in the global south, BRICS and so on and so forth, they can see what China is doing. With the SGE opening vaults in Hong Kong and also Saudi Arabia, and there are probably plans for other ones, or certainly facilities elsewhere, whereby gold can be exchanged for yuan. This is setting up a system which will allow the Chinese, if it is necessary, to protect the yuan's value by turning it into a gold substitute. But that would be at the international trade level. The idea that individuals in China would be allowed to, have a gold exchange, if you like, for their yuan. I mean, I don't see that at all. The authorities in China, I think, are all about hanging on to what they've got. They don't really want to part with it. And I think it would be a mistake to sort of think that the Chinese authorities, whether we're talking about PBOC's reserves or whether we're talking about the hidden holdings, sort of spread around the various communist organizations, government organizations, I don't really see that they will be feeding this new vaulting system outside China. I think they're going to still hang on to their gold. But I think what they will do is they'll say, well, what you could do is you could acquire some gold, put it in that vault. You could exchange it for yuan when it comes to trade settling and all the rest of it, so that you foreign country, have the facility to trade in a gold-backed yuan. They will set the rate at some stage. I think that's inevitably what's going to happen. And it doesn't really require China to part with some of its gold. Maybe a small amount, but basically, I think the idea is to make the yuan, if you like, the dollar's replacement. And this one will be a lot more secure than the dollar. I think that's the important thing. And as the dollar declines, we're coming to, there's no doubt in my mind that we're coming to the end of the fiat currency system. The Chinese, I think, are perfectly aware of this. And they want to protect their currency. They want to protect, their position. And they don't want other currencies, for goodness sake. If the dollar goes down, what happens to the other currencies? They go with it. It's as simple as that. So they will want to trade in their own currency. Of that, I'm absolutely convinced. And they will want to protect the value of their currency. So we can see this is beginning to happen. Now, I think the central banks around the world can see it. I think governments are beginning to see it. I think some of the really big players, like ultra high net worth individuals, the sort of really wealthy families around Asia who liaise with politicians, who have them round to dinner and all the rest of it. I think this is the back chat that goes on with these meetings. They know about it. I think that some of the smarter hedge fund managers in the US probably know a little bit about it or suspect it. The rest of the investment world has not got a clue. But you'll find that the information filters down. It'll filter down gradually as, events unfold. And there will be if you like, a growing understanding actually about what actually is happening. And we're looking at the end of the fiat dollar. I think this is really what it's all about.
And are we looking then at the new Bretton Woods with the yuan as the new reserve currency and backed by gold, just like the US dollar was?
I think that's a good way to describe it, Paul, because the thing about Bretton Woods is that it was this sort of high level, you can't exchange your currency for gold. But this is a system which basically everybody who's in Bretton Woods, we're in there at a fixed rate, and gold basically is the tie for all the fixed rates. And that was fine so long as the Americans, who had the bulk of the gold, certainly in the late 1940s, that was fine until the Americans began to run out of gold. And then, you had the end of Bretton Woods. And Zoltan Pozsar, I don't know, you remember him? He was Credit Suisse. He described the current situation as Bretton Woods 2, and which is not the rather clumsy way of putting it, because it's not a Bretton Woods system in any way. So you had the Bretton Woods system, you had the fiat currency system, and he was raising a question mark: are we going into Bretton Woods 3?
Right. Yeah.
In other words, is this the end of the fiat currency system, and it's going to be replaced by something else? That was the question he raised. And he was raising this question, 3 or 4 years ago? And I think the thing that's really done it was COVID, when economies shut down. There was an explosion in government debt as a result. And it's clear to me that large parts of our economies haven't recovered from that at all. I mean, you've got some zombie companies who took on debt basically because they ceased trading for however many months. They took on debt and they've never really got rid of it. And the problem is that interest rates have gone up. They can't afford current interest rates. And of course, this has led to other distortions. I mean, for example, you've got the shadow banking system, so-called, in America. In this case, we're looking at private equity and hedge funds who use their, if you like, their rating in order to borrow from the banks to lend on to those who basically the banks won't lend to. Why won't the banks lend? I mean, the banks aren't stupid. They won't lend to these companies because they're zombies. So the zombies are getting sort of payday loans out of, the shadow banking system. And that's a big accident waiting to happen. It really is. I mean, and this is what Jamie Dimon was referring to the other day. He's talking about cockroaches. You see one, there are going to be more.
As Alasdair Macleod closes his analysis, he places today's precious metals market within a broader historical and economic context. Drawing from his research into post-World War I Germany, he describes how inflationary cycles and credit bubbles follow recognizable patterns. First, a period of adjustment and devaluation, then a deceptive phase of apparent stability and prosperity, and finally, the catastrophic collapse of the currency. With over $1.2 trillion in margin loans propping up equity markets and trillions more in leveraged assets across the financial system, in this scenario, precious metals are not an investment play, but a safeguard against systemic failure. Gold's role, as Macleod emphasizes, is not to rise for the sake of profit, but to anchor value when paper assets unravel. The same logic applies to silver and platinum, both of which retain intrinsic monetary characteristics despite being industrially driven. When currencies falter and confidence in central bank policy evaporates, these metals become the natural refuge of capital, not because of speculative fervor, but because of their permanence in a world of vanishing promises. He also challenges the modern fascination with digital substitutes like Bitcoin, likening its rise to the tulip mania of the 17th century, a speculative phenomenon detached from monetary law and stability. When the credit bubble bursts, the world will rediscover the importance of tangible settlement and lawful money. Governments will tighten control, not relinquish it, and in that environment, gold's legal and historical status as the ultimate form of settlement will once again assert itself. The coming phase, Macleod argues, will separate those who understand monetary history from those who mistake volatility for failure. For long-term investors, the takeaway is clear. The path ahead may be turbulent, but the underlying direction remains intact. The same forces suppressing prices today are the ones ensuring higher valuations tomorrow. As the dollar weakens and global liquidity fractures, the demand for physical gold, particularly in the East, will only accelerate. This is not the end of the bull market in precious metals. It is its consolidation phase, a critical moment for disciplined accumulation and strategic patience. If you found this discussion insightful, please give this video a like, share it with fellow investors, and subscribe for more in-depth analyses from leading voices in the precious metals space. Thank you for watching.